Welcome back to Primary Source China Investment. Peng Guo and I happy to be back for show E2. And since everybody in China is sitting in traffic on vacation, we figured we'd talk about them. And this week we wanted to circle back to a little bit about the equity market and then touch on the fixed income market a little bit. I was reading an FT article that said institutional investors are pulling back from investment in China on the mainland. And there was a survey done by Invesco in 2019, and they did a similar survey in 2021 this summer. And it said that 12% of institutional investors are decreasing their allocation to China. 12% are decreasing allocations to China. And in 2019, only 3% said that they were decreasing. Also, 64% said that they were increasing their allocation, whereas in 2019, 80% were increasing allocation to 2019. So it's frustrating for us to read this because there's no nuance here. And as our subscribers know, China equity contains multitudes. China stocks listed in the US have been hammered as a result of punitive policy changes on the mainland and bravado from US lawmakers as well. Interesting, mainland stocks have been flat or just slightly down. So year to date, I think they're down 5%. And US listed Chinese stocks, and the largest ETF right now is KWEB at 6 billion or something like that. That's down almost 40% year to date. So there's been a lot of pain. On the China side, the ASHR, there's actually been very little volatility, which is something that we've been saying, China's always volatile, but this year to date, it's been extremely flat. So it's interesting to see that this bifurcation happened a few months ago, and we talked about it on this show a lot. So the question now is this over? Are we into the next phase, next stage? And what is it going to mean looking forward? So I have some thoughts on it, but I'd like to get your thoughts, Peng Guo.
Let's probably see the still from the investment perspective. Let's see the performance of the market. Obviously, KWEB loses the 39, almost 40%. That we know that's the worst sector. So but if you see the Shanghai Composite Index for the year to date return is 2.73%. So it's still positive. That's really not affected by the one sector at all. However, this year extremely difficult for the A-share investors because the sector rotation is pretty quick. If you cannot capture the right sector, that really means you lose the money. So if, for example, if you still invest in the bank or real estate in the early of the year, that's pretty bad. Obviously, white one is a good one. Unfortunately, nobody can predict how the sectors and when they can rotate it. I think that's pretty hard for all the investors doing that like that. So I think generally speaking, balance the allocation, I think it still be a good idea.
Yeah, my thought was more specific on the, and again, I've been drawing a line between stocks listed on the mainland and Chinese stocks listed in the US. And I really don't think it's over. I really think more and more stocks are going to list back on the mainland and back in Hong Kong. Interestingly, if you put up the EWH, which is the Hong Kong ETF, that's actually done pretty, that's been flat as well. So it hasn't had the steep declines that the US listed Chinese companies have. So I don't think that that's over. I think there's going to be plenty more stocks that relist back on the mainland. There's going to be pressure to do that. There's going to be fines for those who don't. There's going to be new regulations that come out, both on the China side and the US side. So I do see that this is an accelerating phenomenon, and we're going to see more and more stocks listed. And maybe that's the way it should be. You should have China stocks listed in China and US stocks listed in the US, and that's how I see it playing out.
Yeah, I see the some companies choose the dual listing. So they go back to the Hong Kong and do listing there, and they still keep the stocks listed in the United States. I think that should be no problem. They really add the backup and also get the more exposure to the different investor, especially Asia investor in Hong Kong market. And that's maybe challenges for the future companies. So I think in China, previously, most companies think about go listed in the United States. It's a good idea because A-share is pretty hard. And looks like the policy change and the decoupling of the United States and China, it's become more and more Chinese companies choose the Hong Kong market. So the current situation, I think probably will keep, but the future, that is really get a significant impact.
Yeah, I think the dual listing or, tri-listing, multiple listing, you take big stocks listed in Microsoft and
that's true.
Google, they're listed in multiple places. They're listed in Europe, they're listed in the US, and that's a normal thing. Although China forbids any international company listing on their exchanges, it's important to point out. Microsoft, if they wanted to list, or Apple wanted to list, have a big business in China, they cannot list on a Chinese exchange. So it will be interesting to see, but in the intermediate term, I do see more and more US listed Chinese companies are going to relist back on the mainland or in Shenzhen, and that's driven by policy, regulations on both sides.
That's true, exactly, yeah.
Yeah, so the other thing we wanted to touch on this week was the fixed income side, because anybody that I've talked to about investment in China for more than a decade now, I've always said, hey, listen, you need to put some money into fixed income. And fixed income has really been shocked through the property developers over the last few weeks, and that's made all the headline news. But if you dig a little bit deeper, you'll actually see fixed income's done exactly what it should do. It's given you about a 3% yield, and it's actually caught a little bit of bid on the pricing side. CBON, really, again, the only real ETF to buy in the US for China-listed bonds, and these are renminbi denominated. So it's had a little bit of volatility, maybe 4% plus or minus, and it's had about a 5% year-to-date return. China's 10-year at the beginning of the year was 336. Now it's about 289. So it's come in a little bit. But again, that's why maybe you've gotten a little bit of price appreciation. But year to date, you got 5%. You took a little bit of volatility, and that's exactly what fixed income was supposed to do. And it did what it's supposed to do. If you were had 50% ASHR, you had 50% CBON, you're basically flat year to date. And for a diversification play, that's not great, but it's also not horrible. You're not down 40%.
As to the fixed income, so firstly, you're right. So that's exactly fixed income should provide a couple of the percent income every year and give the low volatility. At the least, it's a positive return. That's pretty good. And in the Asian market, if we see the 5 years Treasury bond ETF, the year-to-date return is 3.32%.
Yeah, makes sense.
And the 10 years ETF return is 4.38%. So
yeah, that's total
close.
Return, right?
Yeah, that's total return. And also the exchange rate is pretty flat for this year. It had volatility, get up and down, again, down and up. Yeah, so it's a quite a stable year for the fixed income investors.
Yeah. Yeah. So, I mean, that's exactly what we're saying. It did what it's supposed to do. And, those who went whole hog, double fisted into Chinese equities, either in the US with those tech funds, have really paid a price. That's a huge, being down 40%, 38%, I want to be precise, down 38%, that's a lot of pain. There was something else that was interesting that I read about this week, so-called panda bonds. These are foreign companies issuing bonds on the mainland in renminbi. And Peng Guo and I, you and I talked about this offline a little bit. The day of the dollar-denominated bond for China companies may be coming to an end because Evergrande did default on their U.S. dollar bonds. But Daimler and BMW both issued a pretty good chunk of renminbi denominated bonds on the mainland. And it makes sense. They have a big business on the mainland and they need renminbi to fund operations, pay salaries, those kind of things. And it was a 3-year and it went off at 3.7. It was bid up so much, the yield came into 3.5. So it was very, very popular. So I do think you're going to see a lot more of that. Year to date, there's been about 20 billion renminbi issued, which is about $3 billion US dollar. So I do think that this is an asset class that is well worth watching going forward.
Yeah, I think it's a great opportunity. So the China bond market really need to get improved. So it's a big market, but it's really lag for the international standards.
Absolutely.
So I know most of people just so much wanted the return and forgot the two volatilities in the equity market. Definitely bond market is can attract much more money, and I think that's give many public companies or big companies a good opportunity. Obviously, only good big companies can issue the bond in China market.
Yeah, the problem is the investors still playing the moral hazard game because, back to Evergrande for a second, they issued these wealth management products. They were probably, very risky bonds, although have assets behind them. The government has basically stepped in and said those people are going to be made whole. So that sends another message to investors like, hey, it doesn't really matter what happens to the underlying. The government's going to come bail you out, which is a very bad investment thesis because
exactly
it works until it doesn't. And, at some point it's not going to work and people are going to step away. Government's going to step away and that's going to leave the people holding the bag. And that is going to happen. I'm not going to say when, but that's absolutely going to happen.
Yeah, I think some of the investors, for many reasons, they don't want to do the credit analysis to investing in the enterprise bond.
Yeah,
and also the whatever they call the product, the financial product, they hidden the enterprise bond risk behind the product, and make the investor didn't understand that very well. And they just do a lot of the sales job, not of the investment job.
Correct.
And so annoying. So that's right now. The consequence is here.
Yeah.
That's sooner or later you have to such kind of a consequence.
Yeah, but credit risk is hard. Credit risk is hard.
True.
Sales is much easier.
Yeah, exactly. That's true. Yeah, that's definitely is pretty hard work.
Yeah.
People should get a reward to do the hard work and the valuable work.
Correct. And then you need, the point here is if you don't do credit risk and things, go bankrupt and the government steps in, well, then why do credit risk? So, we're talking about the discipline of credit risk and the market is saying, well, it doesn't really matter because if things go bankrupt, I'm going to get bailed out anyway. But, here's the warning. That is going to change. It's not going to be like that forever.
Yeah, that's true.
Yeah.
I totally agree.
Yeah, the final point today I wanted to mention is that it does look like China's economy is going to go through some things, as people like to say. It's the polite way to say it. The headlines are weak: manufacturing, PMI below 50, power shortages, property. All of those things are contributing to some headwinds for the China economy.
Real estate used to be a driver of the economy for many years.
Yeah.
But right now it's just oversized. So any sectors get overdeveloped, that always causes a problem. I think right now, if you don't allow the market to automatically adjust it, it will cause the bubble and get hurt for the entire society. I think right now, China really try to control the risk of the bubble.
Yeah, you have a lot of policies created a lot of this problem. A lot of speculation has created a lot of these problems. So unwinding this big, massive trade throughout the economy is not going to be an easy trick. Sticking the landing with that degree of difficulty is quite difficult. So we'll have to watch and see. So we'll leave it there this week. Thanks for tuning in to show E2, and we'll look forward to seeing you next week. Bye-bye.
Bye.